Hello, everybody. This is Wise here. So today we have Lakshay Gandhi, and he is going to present today 4 strategies to minimize taxes as a realtor. So, Lakshay, welcome again back to our Tuesday sessions. So take it away. Thanks.
All right. Good afternoon, everyone. Thank you for joining in. We will be starting in approx 5 minutes. Until then, I'll just let everyone join in. Hi, good afternoon. Good afternoon. Just gonna wait another 1 minute and get started very soon. All right. Thank you guys for joining in. My name is Lakshay. As most of you guys know, I have my own accounting practice and I provide accounting services to realtors as well as real estate brokerages all across Ontario. So for today's session, I wanted to focus a little bit more on real estate and how realtors can save some taxes. You must have noticed that the topic was how can you save 100K in taxes, but I've changed it to make it a little bit more specific because we're going to be talking about 4 strategies today for how to minimize taxes as a realtor. So without further ado, let's get started. So today's agenda is 4 topics that I wanted to talk about. Number 1 is incorporation, which is personal real estate corporation. Number 2 is buying an electric vehicle and what are the tax write-offs available to us. Number 3 is related to deferring capital gains with vendor take-back mortgage as well as joint venture agreements. And number 4 is how can you use your corporate earnings to buy properties. So number 1 is basically saving taxes by incorporating. All of us know realtors had the opportunity to incorporate starting October of 2020. What does incorporation mean? It just typically means that you can now operate as a business rather than a sole proprietor agent. And when you incorporate, you are basically able to enjoy a lower tax bracket. Doctors, lawyers, and accountants had this opportunity from before, but realtors just got it done, got it approved in October of 2020. So a lot of the brokerage sole proprietor real estate agents had contacted me to incorporate their businesses, and now they will be able to pay lower tax bracket. What do I mean by lower taxes? Let's look at the tax brackets as a sole proprietor agent. So if you are a sole proprietor agent, you would be basically paying based on this tax bracket. So in this scenario, if you're making approximately 43,000, you pay 20% taxes, followed by if you make 43 to $47,000, you make 24% is the tax rate, and so on and so forth. Most of the realtors fall between the 90,000 to $150,000 worth of taxes. So if you are a sole proprietor agent who has not incorporated, you're on the hook of paying 43% taxes. So how can we reduce this? The best way is to incorporate. When you incorporate, the taxes significantly are lower. Why? Because the tax rate on first $500,000 of income, when you incorporate, is actually only 12.2% to 12.5%. Yes, you heard it right. $500,000 worth of income, you're only paying 12.2%. Whereas if you were operating under your personal name as a sole proprietor, you will be paying 53% taxes. Not so pretty. So let's look at it as an example. So if let's assume you were making $400,000 of income. With the $400,000 of income as a sole proprietor, you have rent, advertising, utilities that you pay for, and after total expenses of $55,000, you're left with $345,000 of income. This $345,000 of income will basically throw you into 53% tax bracket. That 53% tax bracket is technically not so pretty because you're going to be paying $184,000 in taxes. Now let's look at the same numbers, but if you were to incorporate. With the incorporation, it gives you the ability to not just pay the regular expenses of rent, advertising, and utilities. It also allows you to pay yourself a personal salary, your wife and kids a personal salary as well, which is again on the lower taxes. So after $400,000 of income, after paying $135,000 of expenses, you're left with $265,000 worth of income. On 265, you're paying 12.2% taxes of $32,000. Now you might wonder, we must be paying taxes on the personal income as well as the salaried income to the wife and kids. What are those? So basically, I have calculated here as well, which shows $10,000 and $7,000 worth. So 10 plus 7 plus 32 still works out to $50,000 of taxes under your PREC model, whereas under your sole proprietor agent, you were paying $184,000. So this results in a tax savings of over $134,000 worth. So that is a very good example of what you should be looking at when it comes to incorporation. So that covers point number one. So strategy number one was incorporating. Now let's look at strategy number two. In number two, we're going to be talking about passenger vehicle or any cars and vehicles that you use for real estate purposes. We all know if you're a real estate agent, car is your number one mode of transportation, and you use your car to go to showings, to show houses, to basically go to your appointments, right? So based on that, if your car is on a loan, you get a maximum deduction of $300,000 of interest on loan. If you are paying a lease, if your car is on lease, you have a deductibility limit of $900 per month, right? And if you want to look at the depreciation, for example, your car is worth $60,000, but $30,000 of that is actually can be depreciated year over year because it's a type of vehicle that is being used for business purposes. So every year you claim a depreciation of little by little, let's say $5,000 every year until the cost of the car is basically going to zero. But what happens if you have a zero emission vehicle? A zero emission vehicle will allow you to depreciate not little by little, but actually a one-time tax write-off. This is our strategy number two. In strategy number two, we're saying if you buy a zero emission vehicle, you can write off not just a fraction of the cost every year. You can write off an entire amount of $59,000 plus HST starting 2022. This number used to be $55,000, but now it has been increased to 59,000 from 2022 onwards. I recently got a Mustang Mach E, which is all electric vehicle. This allows me to basically write off all of my income against $59,000 worth of expenses, which is significant. If I were to buy a regular gas vehicle, I would be technically paying, writing it off, let's say 5,000 per year. But with this, I'm able to write off approximately $59,000. This is very limited time opportunity. So if you are planning to buy an electric vehicle, now will be the time, because this will be phased out in 2028 completely, but the phase out will start from 2024. Let's look at a quick diagram of how the monthly savings would work out if I were to buy if I were to drive a gas vehicle versus an electric vehicle. If I were to drive 20,000 kilometers a year, my gas expense is 2,500 approximately, which is $1.50 of gas per $1.50 gas kilometer per 100 liters. So basically, in an electric vehicle, for the same 20,000 kilometer that I'm driving, it only cost me $430. So you're getting a tax savings as well as some sort of a monthly savings, which will result in a $10,000 saving in your, if you were to switch from gas to electricity, right? Because gas, you might be filling up, $100 a month, whereas, $100 a week, whereas in the electric vehicle, you're only paying $430 for the entire year. So something to think about. Very, very good way of actually saving money that you have, really earned, hard-earned money. So that was strategy number 2. Strategy 1 was related to incorporation. Strategy 2 was buying an electric vehicle, writing off the full $59,000 against your income as an expense in one singular year, rather than doing it every year, which we usually do for gas vehicles. Now let's look at for strategy number 3, I want to talk about what a vendor take-back mortgage is first. So if anyone wants to participate and tell me what a vendor take-back mortgage is.
So, Lakshay, this is Wise here.
So a vendor take-back mortgage usually happens when there is a gap between a bank loan and if anybody is buying a house and does not have full amount to pay, so that the vendor can also give him a portion of it, which is called vendor take-back mortgage. It is a second mortgage.
Exactly. So just in simpler words, a vendor take back mortgage would something be like, I bought a house for $1 million, but because the appraisal are coming back short now, the appraisal value of the house was $800,000. Bank is only willing to give me $800,000 as a loan, whereas I'm short of $200,000. What happens to the $200,000? I can either go back to the seller and ask them to reduce the price of the house, which will not happen because I've already signed the agreement 3 months ago. The second option is I can ask the vendor to loan me $200,000 for the shortfall. That $200,000 would technically be a vendor take back, because the seller of the property is actually giving me a loan, which is the buyer, the lender, for a second mortgage. So now when I close on the property, I'll have 2 mortgages. One will be the first mortgage of the $800,000. The second is the $200,000 mortgage, which is from the vendor. Each of them will have their own interest rate, and each of them will basically help me close on the transaction and help the seller close on the seller sell the home faster. Now he's basically loaning me $200,000 to close out on the transaction. Now let's look at strategy number 3. In third strategy, what I'm trying to explain is you can defer capital gains tax if you are selling your property through a vendor take-back mortgage. So what do I mean by that? Let's assume you are buying for a commercial or an investment property. You are the seller and you are offering your buyer a vendor take-back. If, for example, you have $700,000 worth of property that was sold, and you purchased it at 500,000. So your capital gain was technically $200,000. So my house, I purchased it at 500,000. I sold it at 700. My capital gain is 200,000. That $200,000 is technically my capital gains for the current year. Now I know I don't want to pay capital gains taxes 200,000 because that would get added to my personal income for that particular year, and then I'll pay taxes on that. We all know capital gains taxes are 50% taxable. So if my personal scenario, half of this would get added to my personal income, it will shoot me into the highest marginal tax bracket, which is 53%, and basically I'll be on the hook to pay probably like $50,000 in taxes. How can I avoid paying that taxes? Option is using a vendor take back mortgage. Now, if vendor take back mortgage means is I will allow my new buyer to pay the difference, which is the $200,000 of capital gain in installments of 5 years. If I allow him to pay in installments of 5 years, he would not need to pay me $200,000 of gain in one shot. He would be paying $40,000 per year for the remainder of 5 years. What does that mean? If I increase the timeline that I received this 200,000 from 1 year to 5 years, now I need to only recognize 40,000 every year. I do not need to recognize the entire $200,000 of capital gain in 1 year. If I recognize only 40,000 instead of 200,000, my capital gains tax is reduced automatically because I am basically only reporting $40,000 of income in the current year and the 40 in the following and the 40 in the following. So that will basically not shoot my marginal tax rate to 53%. It would bring my marginal tax rate to maybe 40% or 37%. So this vendor take back mortgage can help you reduce your capital gains tax because you are electing to receive the capital gains in installments over the next 5 years rather than in 1 year. So it's something to think about. If you had a closing coming up and you don't need the money right away, giving the seller the option of vendor take back can help you reduce as a seller your capital gains taxes. Option number 2, the same scenario is just like vendor take back, we can also do a joint venture agreement. In a vendor take back mortgage, it was most likely, you sold the unit and, it's not yours, you don't have any equity in it. But let's assume the situation was different where you had bought a property for 600,000, you invested $65,000 in renovation, and you found a tenant to rent this property for $2,500 a month. Now your total cost of the property is $665,000, and you decide to sell the property 3 months later for $765,000. 765 minus 665, which is what our purchase price was, results in a $100,000 capital gain. How can I minimize this capital gain? Let's assume someone comes to me and they don't want to pay capital gains tax. How can we minimize or avoid paying this? The only way to do this is having a joint venture agreement. What does that mean? It means when I sell the property to the new buyer, I will sell the property, I'll remove my name from the title as well as I'll remove my name from the mortgage, but I will still have a bare trust agreement which will show I still own 5% equity in it, or 50% or 10% equity in the home. Because I own a percentage in a property, even after selling the property to a new buyer, I technically have not disposed of the property. This means I don't need to report a capital gains tax. So just to recap, I can create a joint venture agreement which will dictate that I'm not on the title, I'm not on the mortgage, but there will be a bare trust agreement which basically gives me some equity in the house still, which could be 5%, 10%, 20%. So I have sold it, but I still own a little percentage of it. This can work perfectly if you're passing this house, investment property to your cousin or your sister or someone who you already know, and they can certainly help you in terms of reduce your taxes, because now what could have been $100,000 capital gain on your taxes is just becoming, you can defer it because you technically have not disposed of the property. So I'll take a pause at this. Any questions so far?
Hi, Lakshay.
Hi.
This is Durga.
Hi.
I have a question. If you go back on first slide, one by one, we can check and ask questions.
Devinder, what we will do, let me finish off the fourth strategy and then we'll do that.
Okay, great. Thanks.
Okay, thank you. All right, strategy number 4 is actually how do you use corporate earnings to buy properties without paying marginal taxes. In slide number 1, I basically described how you can technically open your own corporation, and from the corporation you will now be getting checks and your income will be there. When the time comes, if you want to buy the property and you need to withdraw a significant amount of money from your corporation, you are technically on the hook for taxes, because first, if it stays in the corporation, you pay 12.2%, but the day you withdraw the corporation money, you have to pay personal taxes. That's why when we incorporate, we tell the customer that you should be withdrawing only, let's say, $40, $50, $60,000 every year, rather than $120,000 worth of income from your corporation, to minimize your taxes. So let's assume you're in a situation where you earned $300,000 worth of income in your corporation. You only withdrew $60,000, but now you're buying a property and you need to withdraw the remainder of the $240,000 that is sitting inside your corporation. How can you do it without paying the marginal tax of 53%? Because if I were to withdraw the entire $300,000 from the corporation to myself, I'll be paying personal taxes, which is far higher, which will be 53%. If I keep it in the corporation, I enjoy 12.2% taxes, which is only up until $500,000 of income. If I withdraw, 53% if I'm over $200,000 of income. So most of the people leave the money inside the corporation, but as a result, you have lots of retained earnings in the corporation. Now you want to use the corporation money to buy a primary house. The strategy I have is, why don't you sell your house to basically corporation? What does that mean? If you want to buy a bigger house, you can technically sell your existing property, which you live in, to your corporation. Because you're selling it to a corporation and it is your principal residence, your tax rate is 0 because principal residence. But now you are able to get money from the corporation because you sold it to the corporation. So step by step, you had an existing house and you wanted to move to a bigger house, so you sold your house to a corporation. When you sold your house to a corporation, the corporation needs to pay you. When it pays you, the money comes to you and you're able to withdraw all of the money from the corporation. When the money comes to you, you can buy a bigger house or whatever you want to do. And because in the transaction you were selling your principal residence to the corporation, any capital gain is tax exempt because you sold your principal residence exemption rule, right? Do keep in mind there is a land transfer that is triggered from this, but in this scenario, you're able to use the corporation's money to buy and use to basically get a new house. Now, when you buy a new house, you can refinance it, take out more equity, and continue your game. But those are the 4 strategies that I wanted to touch base today. And once again, thank you guys for joining in. We'll take up questions now. Keep in mind, I do these sessions every Tuesday at 2 p.m. So if you have missed this one, or if you want a recording, or if you wanted the PowerPoint, you can email me and I'll certainly be able to share that with you. Thank you.
So, Lakshay, I have one.
Go ahead.
The residence to the corporation. But when the primary residence was bought, was not under the corporation. But you can still sell it?
Yeah. So if Kulsum bought a house and she owns the house and she wants to move to a bigger house, but she does all of her money is stuck in corporation, she can basically sell her house to the corporation, and corporation needs to pay her now, and all of the corporation that was tied or stuck in the corporation will come to Wholesome now.
Okay, but corporation money, but what corporation money is, if I will be buying the house from the corporation, can I sell it also through the corporation, the same house?
Yeah.
Okay, at the same time.
Yeah.
Okay, got it.
Go ahead, Devinder.
Yeah. So can you go on the back slide?
Slide 1.
Yeah, no, that's fine. From here. So the bigger house we want to buy, so we have some money in our corporation. But how corporation can pay our current house money? Because we have maybe $500,000 sitting over here.
Mm-hmm.
But my house value is around 5.5 million.
Okay.
Maybe 1.5 million.
Mm-hmm. So basically, corporation will pay you whatever the money it is having in the corporation to you, and then remainder of it will be financed through a mortgage through the bank, just like you would any other way.
So that means corporation is going to get that mortgage.
Correct.
Because we sold to the corporation.
Correct.
Okay. A little technical. Okay, yeah, go on first slide.
Yeah.
Okay, so for the regular car, so maximum we can do $30,000.
So what it does is CRA says that for business purposes, you cannot be buying luxury vehicles. So they're saying is regardless of however much the cost of your depreciation, the cost of the car is, the first 30,000, we will give you an accelerated rate of 30% depreciation every year. Any cost above the 30,000, we still give you depreciation, but less than 30% per year.
So how we can put as a in our financial statement? So like maybe it's a $60,000 car.
Mhm.
So 30,000 we can put as high depreciation. What about the remaining 30,000?
So basically, tax software automatically once you will enter the full amount, but what it does, it behind the scenes, it breaks it into two different depreciation models. It basically tracks the depreciation separately.
Okay.
It's a bit technical because, like, if you're an accountant, maybe and you've prepared taxes, only then you'll be able to see this.
Okay. So but we have to put 60,000.
Correct. Full amount.
Full amount. If not, like if we missed last year, or yeah, possible we can put now.
You can amend the tax return, but there's cost and benefit. You wouldn't want to amend a tax return unless it's absolutely.
Okay. So yeah, please go to the next slide. So just want to see. Slow, go back. So business tax rate is 12.2%.
Correct.
This is like up to $500,000.
Correct.
So if it's more than $500,000, how?
26%.
26%
Yeah.
flat.
Yeah.
So although it's a 500,000, maybe 1,000 above, so it was flat for 26,000.
Correct.
Okay. If we like get a gain from the in a corporation, how that would be?
Again, what do you mean?
Capital gain.
Same as business, same as like regular income, 50% taxes.
So in a corporation, it's a 50% tax.
Yeah, just like you would get taxed personally.
So no. That is I understand. So that means if I get a gain of say $1 million, so 500,000 will be taxed.
No, 50% of the gain would be taxed. So just like $500,000 is the gain, 50% of this is taxable, gets added to your personal income.
Yes, but that gain was done. That gain was done in a corporation, not personal. So
Still,
250,000 at what rate?
50% once again is the exact same. The difference buying in a capital gains in a corporation versus a capital gain under personal level is the exact same.
Okay, so my question is a little different. My question is 50% of the amount is a capital gain. Say 500,000 I got a gain. So 250,000, that is 50%.
Correct.
That is taxed as a normal tax rate.
Correct.
So in a corporation, so that tax will be 12.3%?
No.
Or it will be different in a capital gain?
50%. The tax rate is actually 50%, not the 12.2%. Because capital gain is considered investment income under corporation, investment income has a different tax rate than a tax rate for business income. Business income is considered any active business income that you do. When you're making a capital gain, that's once off, so they consider it as an investment income. Investment income, it does not get taxed at 12.2.
Okay.
Devinder, we're going to confuse everyone in this slideshow. Let's try to keep this session. Let's try to keep the questions a little bit more less accounting and more generic.
Okay, can you go on next slide? Hello, this is Atinder.
Hi, Atinder. Hanji, go ahead.
Yeah, actually, Atinder on this side. I just have one question regarding this electric vehicle.
Okay.
So, as per you, we need to purchase the vehicle. Any case we take it on a lease, then any benefits are available, or how we can?
Yeah, whether you so basically, if you lease it, then you can only subtract the cost of the lease monthly. Then you don't do depreciation.
Okay.
But if you buy it,
full amount of lease.
yes. So I recently bought the car, and the reason why I was forced to buy is because the lease rate was like 8%, 7.99% interest, whereas the finance rate was 5%. So I had no choice but to go with the lower interest rate option and finance the car. So if you finance the car, you depreciate it a lot more. So I can write off $59,000 worth of depreciation in 1 year.
So, Lakshya, I have a question over here. So this maybe we can spread in 2 years or 3 years also?
If you don't want to, yes, you can.
Okay.
Yeah.
Yeah, you can move on next slide.
So, Lakshya, what's the meaning of phased out in 2028? And you said also.
So basically, this incentive has a cap on it because government is funding this incentive, right? So they're saying is 2024 onwards, we will basically reduce the amount of claims that can be done. So 2024 onwards, they will start denying these ones, and then 2028 onwards, it's completely off the table. It's gone.
Okay, got it. Thank you.
Yeah.
Okay.
Hey, Lakshya.
Go ahead.
This is me. Hi, how are you?
Good. How are you?
This is a good sessions. A lot of information. Thank you for this one.
Thank you.
I have electric vehicle. Sorry, I got disconnected. So my question is, if the price is more than 60,000, which you said we can write up 60,000, right?
Yeah.
What we can do in that case?
If the cost is more than 59,000 plus HST, you will still be allowed to write off maximum of 59,000 in 1 year. The remainder can be depreciated in the following year.
Okay, got it. Perfect. Thanks.
Welcome.
Yeah, actually, this is regarding electrical vehicle again. Like, suppose if I have a annual income of $400,000, and this 59,000, as you mentioned, this side, it will be deducted from 400,000, or
correct.
We must apply tax.
No, 400,000.
Okay, so from 400,000 we subtract 59,000.
Correct, 60,000. So you'll be paying taxes on 341.
Okay, 341. Okay, thank you.
All right. 2 minutes left.
Vendor kickback. So I have a question on that.
Go ahead.
So on a vendor kickback, say I'm giving $500,000. So although I sold for $1 million, so I'm going have to show CRA I sold for $500,000?
No, you will be doing the whole amount and then filing an election saying that you want to spread out your capital gains for the remainder of the 5 years because you haven't received the money fully.
Okay.
So
If vendor take back is normally like I can give to someone on maybe 5% interest rate, principal and interest mixed,
Mhm.
then like every year maybe I'm getting $20,000.
Mhm.
I'm going to pay tax accordingly.
yeah. So
Okay.
the interest will be taxed separately. Again, passive income, 50% taxes.
Right.
Okay, any more questions? We have 1 minute left.
Lakshay, your electric vehicle slide hit the roof, Now we are all going to be buying electrical vehicles.
Yeah, this 2022 onwards, it's became 59,000. It used to be 55,000. So they increased it by another 4,000.
So one vehicle should be in the business, should be electrical.
Yeah, maybe Tesla should write me a check.
No, but the session was really great. Thank
All
you
right.
so much for this session.
Thank you very much. Appreciate everyone joining in. For any more questions, you guys can reach out to me at my phone number and my email address on the screen. If there are no more questions, I would like to wrap this off. And
Just one quick question.
go ahead.
Yeah. So
If we get cut off, call me. Call me on my number if we get cut off. All right. Thank you. Hi, Wes.
Okay. Good session. Lots of good strategies there. So yeah, I guess Tesla does need to write off a check for you for promoting the electrical vehicle for all the realtors.
Thank you. Yeah, I personally did not go for a Tesla. I went for a Ford Mustang Mach-E, but to
You
each
had a
their own.
Ford Mustang before, right?
Yeah, I had a Mustang before,
Yeah.
and now the SUV.
Yeah, nice. How do you like it?
Quite a change, right?
Yeah.
Very big change. I think it was the right decision because it started to snow today as well. So
Yeah.
for those of us in Canada, they're seeing the snow a little bit outside. So I think it was the right decision.
Yeah. So are you okay with the charging? You have put in a charger at your
Yeah, I
home.
had to install the charger.
Yeah.
And it was a little bit expensive on that end, but it's a one-time cost, right?
Yeah.
If you want another tax tip, there's something called Ontario Greener Homes Grant.
Right.
If you apply for that, you get $5,000 rebate on your taxes.
Right.
So these kind of changes that you do can actually work in your favor.
Definitely. Oh, that's great tips. Thanks again. We'll conclude the session and looking forward to the next one.
Perfect. Thank you, Wes.
Bye.